Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guide TV. All right, markets are rocking and rolling, ebbs and flows, I guess, right? A lot of still a lot of, we don't know much, and a lot of people are saying this about the next administration that's coming in. So there's still some excitement out there because the policies aren't there, but there's speculation as to how the policies are going to change. So the market has been a little bit volatile, but in general, I feel like there's euphoria in the marketplace. So we've seen the VIX index actually drift lower. We're down around the 15% level. And then we're seeing the S&P 500 index drift higher. Right now, we have them. The index is really struggling with the 6,000 level. We're up 23 points today. We did hit 6,000 at one point in time. Right now, we're at 5,992.30. So up a little bit earlier, now selling off a little bit. But I think more importantly, the Russell 2000 index is feeling pretty good. That's up 2.33% today, or up 58 points on the day. The Russell 2000 index is at 2,465. IWM is how we kind of track it. That's at 244.80. I think that's the most used trading vehicle as far as the Russell is concerned, which is the ETF that tracks it. And to start with, I just want to check in on our Amazon position. We got a December position on where we sold a call spread. The 200 level, if you look at the chart on Amazon, is a very interesting level, a level of support and resistance. On the way down, it was showing some support, and now on the upside, it's got a little bit of resistance. We're at 199.70, and we put this trade on for 80 cents. We went out to the December 20th expiration. We sold the 192.50, and we bought the 187.50. We're 5 points wide. We brought in 80 cents for it. It's now trading for $1 at this point in time, and we're just going to stay the course with it. Want to just point that out. So then today, the new trade I'm going to look at in the SPX. Always try to come up with something in the SPX for Options Guide TV. And the markets are once again a little bit bullish. We do have a short week because of obviously the Thanksgiving holiday. And we also have some economic news looking at core inflation rates coming out this week. So we will have some news that will hit the market. I think it's on Wednesday morning. And then we have shortened trading sessions. So interesting enough, if I'm going to do a trade in the SPX and I want to get bullish this week, I'd like to do the long call spreads because we have a way to adjust that trade. But I think I want to do just a short term, 1 week to expiration short put spread. I'm going to remain bullish on the underlying stock, but it's going to be a very high gamma trade, which means it's going to be hard to adjust the trade if we do this. But what we're hoping is that as we head into the holidays, we get a little bit of doldrums and not a lot happens in the marketplace. So if we go out and look at our expiration date, our calendar, the 29th is this Friday. And so we have here, we're going to have a shortened trading day on the 29th, which is 4 days away. And nothing usually has a tendency to happen on that day. So that's what our goal is. We're going to try to take advantage of that scenario. We're going to go down on the put side of things. We're going to go 1 day. We're going to go down one standard deviation, and we're going to sell a put beyond that price. All right. So inside the Tradier Pro software, highlight the one standard deviation move, and that's down around 59.25 at this point in time. I like the nice round numbers, so we're going to sell the 59 5,900 strike, and we're going to sell that option contract, and then we're going to go down 10 points. Why did that just start spinning? And we're going to buy the 58.90 strike. Okay, there we go. And we're going to bring in a net credit of 70 cents on this trade. And you could even go to the, if you, depending on your risk tolerance, that's 1,000 points of risk. 58.95. You can do a little bit less. You'd probably cut the actual premium received in half. Part of the reason why I'd want to do this, I'd like this to be trading for $1. It's trading for 70 cents. I guess I can move it up one. Let's, how much difference it makes if we go to 59.05. The market was up a little bit higher when we started this. Let's see where we're at right now. So let's look at the 59.05. Let's look at that one, go down 10 points and buy this. 80 cents. Yeah. Was it worth a dime? I think I'm going to do the 5,900, and that's going to be the official paper trade for this week. I'm going to sell this option contract, and we're going to buy the 59.80. And this is just going to be to have a trade on this week. We're going to look at 70 cents on that. That's what I'm going to try to get. It's bouncing around that level, but that's going to be our official paper trade. We're just going to sell a bull put spread in the SPX heading into the holidays, hoping the market doesn't make more than a 1 standard deviation move to the downside. We're going to be risking 10 points to try to make 70 cents on this trade. And in the risk reward scenario, we're looking at $1,000 up front to be short this put option, and we're looking to try to make $70 on that trade. Very high probability of success. We're selling right now the 12 delta, so there's a 88% chance that the market will stay above this strike by that date, and that's the trade that we're going to ride with this week in the SPX. Normally, I like to just set up a long call spread if I want to be a little bit bullish on the underlying, and then we have our adjustment. In this trade, the market just goes against me. I would just get out of it. If it ever got down to the 59.30 level or whatever, and I'd be down about $1.40 on the trade, I'd probably get out of it. I'm just hoping that the market stays where it's at and implied volatility comes in. We get a whole bunch of time decay because we have a shortened trading week. That's simple. That's the analysis that's behind it. Now, on the other side of the coin, see what I did there? We're going to look at Coinbase. So the market obviously has a lot of euphoria as far as Bitcoin is concerned. Once again, there's no policies that have been implemented, but the market, yeah, I'm a little bit worried about this situation being a buy the rumor, sell the news. And if we look at the chart in Coinbase, just an explosive move to the upside. And there's a lot of volatility here, a lot of volatility premium in all of the crypto stocks. But Coinbase is the exchange that actually trades all the cryptocurrencies, probably one of the largest that's out there. Pretty well managed company. If you go all the way back from where it came public, it's still actually at its low. Well, let's go back. Let's do 1,500 days. All right, it's not going to cooperate. Oh, it's minutes. We need days. Let's go 1,300. Why is it going minutes? There we go. Okay, so if you come all the way back to when the company first came public, it's actually up around this level, but this is where the next stopping point would probably be at. So the market came public up here, Coinbase did, ran all the way down, and then tried to make a move back to the upside. So I want to be above this level. I think that is a natural stopping point. And I'm going to sell a call spread. Not that I'm necessarily bearish overall on the space. I just think it's a little bit overblown. Look, this is parabolic, the way the stock has gone up. But it has done that before. It has had strong moves to the upside. But look at these two huge candles. And it obviously trading at, the PE ratio is 67 times earnings. It's just overdone. So let's try to sell some of the vol. It's overdone and it's still got a lot of volatility premium. So let's try to take advantage of that. So 360 is the level. Let's sell something beyond that level on the upside. So we're going to go out to the December 25th expiration. I don't want to be this, I don't want to ride this to the end of the year. Here's the 360 level. We're going, let me say it. I don't want to be in this trade at the end of the year. We're going to sell the 25-day. We'll probably get out after 10 days or so. Time decay will be huge. Look at the money option contract right now. It's still trading for $30 on a $300 stock. It's a very expensive underlying. The implied volatility is at 90%. Wow, that's even higher than I thought it was. 91%. So we're going to sell some of that, and we're going to go out about a 1 standard deviation move. We want to be above the 360 level. We're going to sell the 380 and buy the 390. So here we go. $1,000 will be our risk. And the 390 is here. Oh, I did 2 of them. Okay. I'm like, that's way too much of a credit. Sorry about that. I clicked the button twice. That makes a lot more sense. Okay. So we're bringing in 160. Got a high probability of success. Not to mention, if you look at the chart here, right, this level is right here, and that's 368. We're going to go back. We're going to sell the 380 level, and we're going to buy the 390 level. I actually don't even mind if you want to go beyond the 1 standard deviation move by this and sell the 390 and buy the 410. But I like the 160. We have 10 points of risk. We're bringing in 160, so that's 840 is the total risk on this trade. If this gets down and starts trading for south of 50 cents, I want to get out of the trade. If it doubles, I might adjust this trade. I could see rolling this trade. We might roll into a butterfly if we need to. But I like that we got the parabolic move. We're getting a lot of implied volatility. It means that it is feasible that it could reach that price. But I think we're going to have a lot of struggle to break through that high that we saw back when the company first started trading and first was going public. And that's going to be it. That's going to be our trade for this week. And we have a comment. Let's go ahead and send that one up. Okay. Just curious, what makes you choose a modified butterfly over a straight debit spread in many situations? What makes you choose what makes you choose a butterfly? Here's a question from Mark. Mark saying, what makes you choose a modified butterfly as opposed to just doing a debit spread? Well, if I'm doing the modified butterfly, that gives me a little bit more upside. So in a situation where in specific situations, like when we're trading around earnings, and you see a lot of times around earnings, the expected move gets talked about, and you can target that range. With a modified butterfly, you have more upside if the stock does what you think it's going to do, if the stock does what the market says it's going to do. And the best way, and I don't like to use this as much, but it is kind of the best way to look at it, is the expected move after an earnings is like trying to bet the over under on a football game. If 2 NFL teams are playing each other and they say the market is they say the total points being scored, which is a very popular thing in the betting world, is going to be 50 points. Do you think they'll score more, or do you think they'll score less? And it's amazing how close, when you have a lot of people betting on one thing, how close that they can become on that number. How close, every once in a while you get the extreme where one team gets blown out versus the other team, and you get the unexpected outcome, which also happens in the stock market. But if I'm trading a modified butterfly around earnings or something like that, I would be more tempted to do the modified butterfly because if I'm correct and it just moves the expected move, I actually get more than if I just went out and did a long put spread or a long call spread. And a lot of times you can get it done for cheaper too. So you are modifying it. You still have the upside if the market blows through your butterfly and goes all the way to the extreme on the upside or on the downside, you still can get paid for it. But you got that chance that it might land close to that strike. And whenever I'm doing them very short term. It's usually 2 or 3 days to expiration, maybe a week. And that is going to be my outlook with those type of trades, because when you modify it too, you also are selling 2 option contracts that you need to go to 0 if you're correct on your forecast. So you got to be cognizant of time decay. Time decay is your friend if you're correct on your forecast on any butterfly, but it's also your friend on just long put spreads or long call spreads also. But most of the modified butterflies that we've talked about here on the show have been around an earnings event. In general, I mean, you can look at it. Another alternative too, I guess we've done some of them in the SPX, and that's mainly because we have such a high dollar index, and that's also the case when we're looking at it that way. All right, so this is going to be our trade this week. So let's summarize what we have. This I'll give you the read back on the official paper trade for the week. The trade that I want to add to our portfolio of short spreads is we're going to be selling some of this volatility premium in coin. We're going to go out a little less than a 1 standard deviation move. We're looking at a delta right around 29 in this scenario, but I like where it is relative on the chart. We're going to be selling the December 20th 380 strike call, and at the same time using that same expiration, buying the 390 strike call. We're going to look to get this done for 160 in the account. Market's moving all over the place, but that's where we were at when we were looking at it. And that's going to be our official paper trade for this week. If you got to move it down a little bit, I guess I would leave it at 150, but I put it at 160 and just leave it there. Like I said, the stock's very volatile. See if it hits before the noon hour, and then maybe adjust accordingly. 153 is where that mid is at right now. We're close. And then on the other side, let's send this to the what if calculator, is just going to do a fun trade in the SPX, honestly. Just trying to take advantage of the fact that we have a shortened session this week, and we're going to go out of the money, and we're going to sell that out of the money put spread. We're going to sell the 1 week out. So we're looking at the November 29th expiration. And we're going to sell the 5,900 and buy the 5890. And that's going to be our just fun paper trade for this week. Something to look at. And we'll be back on Wednesday. We'll have a show on Wednesday. We'll review this on Friday. I'll have something taped for you on Friday, that's for sure. But this is the 2 trades that we're going to look at this week. The Coinbase trade is something that I have on in my own account, trying to sell some of that portfolio. This is a fun trade this week. I didn't personally put this trade on, but we'll watch it and see where it goes. Any other questions or comments? Nope. That's it for this edition of Options Guide TV. We'll see you on Wednesday before the Thanksgiving holiday, and we will review the trades that we have on for this week. And also, if you'd like to learn more about what I'm doing out there in the space, please follow me on x.com. My handle is @BrianOverby. And obviously, if you'd like to learn more about these strategies, please check out optionsplaybook.com. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.